At our recent roundtable, I spent time highlighting some of the key themes which have affected fixed income markets over the course of 2014. At the start of the year, the US 10-year Treasury bond yield was anticipated to increase by 50 basis points, from a starting level of 3% on 31 December 2013. However, over the course of the year, US 10-year Treasury bond yields failed to increase beyond the 3% level and has spent the year continuously strengthening down to a current level of about 3.25%. This has caught markets by surprise and had ripple effects over global fixed income markets. Here in South Africa, at the start of the year, the consensus expectation was for our 10-year generic bond yield to increase by 50 basis points as well, from a starting point of 8%. However, over the course of the year, bonds have rallied and now sit at a level of about 7.75%. So, at the start of the year, you had all these bearish expectations for both US and South African rates, which have failed to materialize, and in fact, yields have rallied. There's been a few key themes, especially here locally, which have influenced our local rates market. Number one, in January, we had a surprise interest rate hike by the South African Reserve Bank of 50 basis points. That got rates, our local rates market, selling off tremendously over the course of the month. However, the bearishness that was priced into the market was quite excessive and has dissipated over the course of the year, as we've only seen one subsequent interest rate hike by the SARB, and that was in July, and that too by only 25 basis points. So the expectation which was built into the market and priced was quite excessive and very bearish, which, as time has shown, failed to materialize and provided a supportive backdrop for our rates market. Later on in the year, we had concerns over emerging markets, which failed to materialize as well. Emerging markets started the year with a very strong valuation backdrop, which has supported them over the course of the year. And while the headlines affecting emerging markets were quite negative, the valuation underpin has supported them quite well. In May, we had the national general elections here in South Africa, which as always leads to some anxiety in our local rates and FX market. But that too went through, well, it occurred without great fuss, and the markets were relieved subsequently, and the valuations at the time were quite supportive, and it turned out to be a non-event. In June, Standard & Poor's and Fitch Rating Agency rated South Africa on Friday, June the 13th, and the ratings downgrade by Standard & Poor's was very widely anticipated. Rates market sold off in anticipation of the event and subsequently rallied as it was all priced into the market and some more. In September, there was the FOMC meeting where FOMC chairperson Janet Yellen spoke. Her rhetoric was quite dovish, however the forecasts for the FOMC members was quite hawkish. The market interpreted the overall assessment as quite hawkish, and we had a sell-off. However, once the minutes were released for the actual FOMC meeting, it was quite dovish in nature and markets rallied, again highlighting this theme whereby the market expectations for events are quite bearish. However, the reality is quite dovish, and therefore markets subsequently rally. Our very own medium-term budget policy statement in October was anticipated to be a very bad news budget in terms of bad news coming through from the fiscus. However, the new finance minister provided a good news budget, much against market expectations, which led to a significant rally in our South African bond. So all these events highlight something which has been a key theme over the course of 2014, whereby the market has been quite bearishly positioned, expecting the worst, pricing a lot of negativity into our rates market, which didn't quite help all that much in the face of a very strong valuation underpin. We currently view rates markets as being fairly valued to slightly expensive at current levels. And a lot of opportunity has been offered on the table over the course of 2014, where when the market runs away from fundamentals and a valuation underpin, it creates a favorable backdrop for active investors such as ourselves. Thank you very much.